Right, I think we'll get going with this webinar. Hello and welcome to this Mills and Reeve webinar on taxation in the construction industry. I'm Alison Garrett. I'm a senior legal advisor in the construction team here at Mills and Reeve, and I'm joined today by my colleague and taxation expert, Tim Waters. Before we get going, there are a couple of points to make to you. Next slide, please. Firstly, this webinar is being recorded, and the recording and the slides will be sent to you in due course. Second, if you have a question, please do fill in the question in the Q&A box at the bottom of your screen. We will endeavour to answer as many of the questions as we can in the time that we have available. This webinar is slightly shorter than the previous construction webinars that we've held. It's due to last for 30 minutes. Next slide, please. The construction industry has seen a number of changes regarding taxation, which are either just happened or about to happen or are proposed. And today, Tim and I are proposing to talk about 5 of those. Tim will discuss the first 4 and I'll pick up the 5th one. The issues we're going to discuss are the VAT reverse charge, which came into force earlier this month, changes to the construction industry scheme, known as the CIS, and to IR35, which are due to come into force in April. And then Tim will just briefly talk about the Construction Industry Training Board levy, and also he'll touch on the aggregates levy proposal, which the government announced last week. And then I will round off by dealing with the proposal for what is known as the cladding tax, and briefly discuss other possible sources of revenue for the government in terms of the cost of remediation of cladding in the light of Grenfell. So over to Tim to talk to you about that reverse charge.
Thanks very much, Alison. So this will be a high-speed gallop through the various tax changes. Construction is an industry which is seeing a disproportion of changes coming in, amount of changes coming in, both as a result of new changes emerging and as a result of some delayed old friends which were meant to come in quite a while ago and have been delayed due to the cumulative effect of Brexit and COVID. The first 3 we'll be talking about, the VAT reverse charge, CIS and IR35, are all changes which are effectively shifting the compliance burden away from smaller and towards larger entities. And with that background in mind, we'll go to the first of that reverse charge. So this is long awaited. This was originally scheduled to come in the 1st of October 2019. And the background to it is a concern about a degree of organised crime targeting the construction industry in the form of subcontractors who are thought to charge VAT to contractors on their fees and then not actually pay that onto HMRC. So as a result, they simply take away the 20% further VAT. The mechanism that's being used to deal with this perceived threat is a reverse charge, which is technical jargon for self-charging VAT. So where a subcontractor is making a supply of construction services, and the definition for that will be familiar, it's quite similar to that under CIS, then the recipient of that will be self-charging VAT. So effectively, they account to HMRC for 20% of what they would be, what they'll be paying to their supplier. That means that effectively there's an extra compliance burden not alleviated by or not expecting a VAT invoice from your subcontractor. It's worth noting on this one that the VAT includes materials alongside the services. That's a difference from CIS. And the logic here is this is about the VAT charge on the suppliers as a whole, whereas CIS is targeted around the markup and payroll obligation, where there's thought that the payroll obligation might not be complied with by the subcontractor. As a result, this can be on a somewhat larger figure. There are a couple of exclusions, which I hope we can gallop through. Firstly, the end user exemption, similar again to CIS. So if the supplies are being used for a reason other than a further supply of construction services, for example, and principally on the end user's own land, then you can have an exclusion from the reverse charge. So the idea is targeting within subcontractors within the construction industry, but not necessarily end clients of them. There's a related intermediary exemption, meaning, for example, group members who are just going to pass the services on within a group. There are a number of conditions to this, and it depends on a notification being given. So it's not simply an easy win that you can forget about this outside the industry. There's also an exemption which broadly tags where supplies would fall outside the CIS, with some provisos to that. But the intention here being to align the application of this with the CIS compliance. So normally you'll be considering both at once. And finally, there are exclusions, I'll call them that, for zero rated supplies or supplies to persons who are not VAT registered. The logic here is that zero rated supplies are supplies in which, although VAT might be recoverable where it's attributed to them, they don't themselves attract VAT. So as a result, you do not end up with any VAT to charge, and non-VAT registered persons would not have the system to charge themselves VAT or an account with HMRC to do the self-charge on. They're also exempted. Practicalities, 1st of March, but no need to panic in that. That will simply mean the self-charge should be reflected in the next VAT return. The end user exemption requires a notification. And then finally, that has the knock-on effect, as lawyers love drafting, that contracts will need to include some form of notification or provide for a reverse charge applying rather than the supplier issuing a VAT invoice. Next slide, please. So closely linked to the VAT reverse charge is the CIS, where again a similar issue is being dealt with, albeit on a different tax. So this is due to perceived non-operation of payroll by some subcontractors in the industry. And the way that it's being dealt with is that the contractor, or a deemed contractor, which can go further than the person in the construction industry, who makes a payment in respect of construction services to subcontractors, have a withholding obligation unless the subcontractor has signed up and registered to show that it's tax compliant, so that it is behaving, it is doing its payroll, and therefore HMRC isn't worried about this withholding on account of the subcontractor's payroll obligation. The way that falls is an extra compliance burden for the contractor. So the contractor has to register for CIS, and subcontractors are of course heavily incentivized to, because otherwise they get withheld upon, albeit that withholding is then credited against their payroll, because the purpose of it is to collect at source when the payment is going to the subcontractor, rather than trusting the subcontractor to do the payroll withholding they would be doing. A couple of changes here. So the first is a clarification about the cost of materials, which I mentioned is outside the scope of the CIS withholding, because CIS is aimed at the payroll element of it, so the markup that the subcontractor is getting, and not merely at the overall aggregate cost, including its materials that it will charge for its service. That clarification about what cost of materials is, there's two elements I want to draw out here. Firstly, it includes the hired plant, so for example a scaffolding charge where that's leased, but it doesn't include any form of markup or charge for use of what the subcontractor already has, because this is aimed at tackling the non-materials element, not the infrastructure, but the supply of services, which will have a payroll obligation behind it. The second point, and this is a slightly more concerning one in some respects, that the ICAEW is taking up, I understand, with HMRC, is that under the clarification, this will allow deduction for the direct cost to the subcontractor of materials to be used, but it won't allow deduction necessarily if there's a chain of people who are contractors or deemed contractors, and at the end the subcontractor is supplying construction operations which have a cost of materials element. So an obvious example there might be a landlord and tenant, where the tenant's doing fit out works and the tenant approaches as a subcontractor to make sure that obligation is met. if we imagine the landlord's paying the tenant notional 100, and the tenant is paying the subcontractor 100, for which that divides 60-40 between works and cost of materials, then the landlord only looks at the 100. It doesn't look through to that 60-40 division. So it might have to withhold on the tenant based on 100, even though the tenant will only be withholding based on the 40. You can end up with a slightly odd mismatch in that scenario, which, although ultimately this is a compliance point, is going to be a bit of a compliance headache potentially for people in that scenario. There is some guidance on evidential requirements related to cost of materials, where you can't necessarily take the subcontractor's word for it. And the second bevy of changes, which again I will race through with time for questions at the end, relates to the concept of a deemed contractor. So these are not contractors as we know them, as in contractors within the industry, but big spenders on construction services outside it. Previously, there was a 3-year period where your spending had to average 1 million a year over that period. Now, if your expenditure exceeds 3 million within the last 12 months, then this triggers. This is generally safer and a higher threshold, but it can trigger all at once in a degree that wasn't possible before. And as a result, we could find that large spenders on a particular project might be catapulted into being deemed contractors. There's still an exemption, I should mention, for effectively equivalent to that VAT end user exemption for expenditures on property that falls into certain category. Offices and warehouses are the main examples that are used for the purposes of the deemed contractor's business. So they're doing it on their own land. There are also some admin changes relating to HMRC's ability to levy penalties and to amend CS deduction amounts claimed by subcontractors on their real-time payroll returns. But practically speaking, we would hope there wouldn't be supplies of false information in any case, and HMRC's powers in the area are, overall modern for a modern introduced payroll deduction tax. Next slide, please. Next in the trio of a theme of moving tax compliance towards the larger entity who HMRC can monitor more easily is IR35 off payroll working. Anybody who has attended any tax seminars in the last probably 2 years will have seen something on this much heralded change. The core of it is the discrepancies between the tax treatment of employment, self-employment, and I should add a third there, employment, signing up as a consultant via a personal service company. Personal service company consultants, so individuals who go via that company, can achieve a better tax treatment through paying themselves a director's fee and dividends. This had been postponed several times, and now we are, so this has been postponed since 1st of April, and now we're finally facing it coming into force after COVID had pushed a 1-year delay. Formally, the position for personal services companies would be an individual services are being supplied to the client through the personal services company or another intermediary entity, and the PSC is responsible for determining employee status and paying tax. And because the PSC is wholly owned by the individual, they tend to come to the conclusion that the individual is not an employee, that there's no payroll deduction, and the individual can extract profits in a more tax efficient way through dividends and directors' fees. From 6th of April, that employment decision, so on what the employment status of a worker is, has been shifted away to the end user, even where there are also agencies in the contractual chain, provided the end user falls outside the conditions not to be a small entity, which are the familiar ones across quite a few different taxes, notably R&D, for having sufficient turnover in employees. The implications for that is that any of these entities which are sufficiently large have to make a decision on whether the person providing the services through the PSC is truly speaking an employee or is actually a consultant providing services but not sufficiently controlled by and having their time tied up with the end user. if they think that actually they're better described as an employee. And there are a number of tests here, including a HMRC CEST assessment tool, which is intended to give HMRC's view on who's an employee and who isn't. Then the responsibility for operating payroll falls on that client, and as a result, HMRC, just as when an end user or any company attempts to pay employees, HMRC would expect PAYE and NICs to be operated. The responsibility can be shifted to the agent by making a status determination statement for them, but the starting position is that the end user, so the client, even if there is an agency, is going to be liable and is going to have to think about whether employees or whether workers who claim to be consultants working through PSCs are actually employees. It's obviously a complex area, and there's a fairly rapidly developing body of case law on who is an employee and who isn't. But the core here, I think, is that if you have people providing services to you through personal service companies, whether that's directly or indirectly, you should now be thinking about whether to also put them on the payroll, and fairly rapidly given the change of the tax year. Next slide, please. And last in the gallop of commentary from me is the CITB levy, the Construction Industry Training Board levy. So the levy itself obviously isn't news to anyone. It's a pre-existing levy to employers engaged mainly in construction industry activities, which the CITB class as 50% of total employee time. The amount of the levy obviously depends on all your employees and the aggregate amount paid to them. I should mention here that this does have a crossover with IR35 and CIS, because IR35 can take people who you thought were consultants and treat them for tax purposes like employees, which means they go onto the payroll. So they change your CITB levy categories. And CIS deductions also count in a slightly altered form, but also count towards your CITB levy. The main news here, just in terms of updates, is so levy rates obviously stayed the same, and there's a plan that's been mooted for a while, which I don't believe has yet been formally confirmed, that they'll be reduced by 50% for 1 year. The consultation is also underway, which is leading up to the consensus process to change the future levy rates. That's running till 11th of April. So if you have a burning desire to express your view on the CITB, then that will be a chance to do so. And lastly, sneaking in here to further compress the roundup of tax changes is the proposals to the aggregates levy. So this is probably something which you're either already familiar with or never desire to go near. So I won't linger too much over it. It's a levy on the commercial exploitation of primary virgin aggregate. It has faced many challenges and is now being reviewed by HMRC. There's particular concern that almost everything can fall within exempt aggregate, not subject to the levy, and that almost anything near the main construction site can be a borough pit, which transforms into exempt aggregate. A consultation is underway. The levy rates are still frozen, but since this is one which looks potentially like it may well change, it's worthwhile kind of going hot off the press off the announcement of this consultation. It's worthwhile putting your 2 pence in to the government on where this levy is going and how it can be made a sustainable and operable levy without a major compliance burden. And that's me. So to recap, 3 changes shifting compliance to the larger entity, generally the contractor, and 2 changes to industry relevant levies, both of which are now running consultations and are therefore worth inputting on if you are interested in and are already engaged with those taxes. Over to you, Alison, on cladding, which is more speculative, but also probably arguably more important than anything I've said to the future of the industry.
Thanks very much, Tim. Yes, I'm just going to finish off this webinar by talking about cladding and the proposals that the government is putting forward in relation to cladding and taxation. This, as you will know, comes as a result of the Grenfell tragedy and the fact that the government has committed itself to spend £5 billion so far to assist in remediation works required on residential buildings that are over 18 metres in height. It's also committed 30 million for waking watches, i.e. basically for security on high-rise residential buildings that have not had their cladding as yet removed, to warn in the event of a fire occurring. We were hoping that the government would add some flesh to what we already knew when it had its tax day last week. In reality, it's provided very little further information. But to run through what we know at the moment, the position is as follows. The government is going to propose a cladding tax on the largest residential property developers. It's not as yet clear who exactly will be covered by that. The largest developers will be fairly clear that they're covered, but it's not at all clear where the cut-off point will as yet be. The government has said there will be a consultation on this proposed tax in the coming months. But bearing in mind that it's also said that it would like to introduce this tax in 2022, there's little time to waste. It's not clear how it proposes to levy this tax as such, but the suggestion is that the most likely way is through corporation tax. Lastly, the final point to note about the cladding tax is that the government itself has said that it expects that it will be able to levy £2 billion over a decade. Well, bearing in mind that I've told you they have committed to over £5 billion, that still leaves them with a shortfall of £3 billion to make up. One other thing they have suggested, the government suggested earlier this year, is a levy on new builds. And here it is said that when developers seek permission to develop certain high-rise buildings in England, there will be a levy. They talk about Gateway 2 developer levy. Now, Gateway 2 language comes from the Building Safety Bill, which is presently going through Parliament to deal with potential changes and safety measures following Grenfell. And Gateway 2 itself is defined as pre-construction, all of which makes perfect sense. Most commentators, I think, have assumed that the levy will be on residential high-rise buildings in England. But the government hasn't said that, so it is something that's a bit of a moot point so far as I'm concerned about whether in fact it will be limited to residential buildings. I think we can assume that high-rise buildings is likely to mean anything over 18 metres in height, because that's the general anticipated view in relation to the Building Safety Bill, that we're talking about buildings that are over 18 metres in height. And lastly, and this is slightly speculative, but I noticed that in the press recently, an MP had asked Boris Johnson about whether there might be a tax on the building products industry. Those of you that have been following Grenfell recently and the developments in the inquiry will have seen that the building products industry hasn't perhaps come out covered in glory at the moment. And Mr. Johnson's response, perhaps unsurprisingly, was that it was something he would look into. And it seems to me that it's a likely source of potential revenue, and an additional tax. It's potentially attractive politically. And as I said, the government has got to find several £1 billion more than it already is proposing by way of the cladding tax to cover the shortfall in the remediation works. And that is in relation to remediation works solely on residential buildings over 18 metres in height. That, as we probably all are aware, is simply the tip of the iceberg, and this could cost the government and therefore the taxpayer considerably more money unless the government chooses to find other ways, other forms of taxation and levies. That's everything that Tim and I have to say. We're now open to questions. I'll check to see what questions we have. First one to you, Tim. It's to do with the VAT reverse charge. Can you expand on the end user notice provisions now required? And in particular, do you have any view as to whether any amendment should be made to the standard forms of building contracts, such as JCT and NEC, in relation to this charge?
Sure. So I think as a matter of prudence, you need to have some form of drafting ideally baked in for this. Simply having a VAT clause saying if VAT is due, then a VAT invoice will be levied on a supply and payment will be made. That isn't incorrect, but it doesn't necessarily deal with the scenario of knowing whether the subcontractor should be issuing a VAT invoice as they would for an end user, or whether the contractor should be self-charging. I know there's a HMRC suggestion of wording for the end user exemption. So a notification saying we're an end user, we won't do the reverse charge, and instead treat it as a normal supply of VAT, a normal VAT invoice, and you want to comply with the notification provisions there too. So it seems to me, ideally, we'd see the clauses that are currently in place in JCT, which I don't think have been amended to deal with this, do not cover all of the scenarios. They don't deal with where there's a reverse charge. They're not wrong, but they don't allocate it and give clarity between the parties. So ideally, what we would see would be a baked-in notification based on whether the reverse charge applies or not, which could be tailored to deal with the scenario where the end user confirms that that's what they are, or left as is, where it's between a subcontractor and a contractor. So in short, don't believe that this has been reflected in any of the standard documentation yet, although I know that suggestions have been made. I think that some boilerplate wording would deal with the risk well, and I hope the JCT incorporates it.
Thank you, Tim. Just time for one last question, I think. This sounds quite specific.
Sure.
And we may not have an answer for you, but the question is, I have a retention due for works completed in March 2020. Application was raised before the 28th of February 2021, but it's not yet been certified for payment. Should that be added for payments?
I mean, I think the first question is whether you are an end user, and hence whether the exemption applies in the first place. As it's after 1st of March, then the question is going to, or as at least the service provided after 1st of March, albeit the payment has started to move through your own internal system before that, then the question will be when the time of supply is and whether a transitional provision applies.
I think the supply would have been pre-March 2020.
Oh, I thought you said the services were provided in March 2020 and payment hadn't gone through yet.
Yeah, it's retention with the application was raised before the 28th. Retention due in March 2020, application raised 28th of February 2021.
Oh, I'm sorry, I misheard you. My bad. Okay. Yeah. So, yeah, the question is going to be whether the transitional provisions change that. I would expect off the cuff that you're probably going to be within standard VAT rather than the reverse charge, but I'd have to actually advise on that. And check the provisions to be sure.
Yes, that was my feeling too. Yes, yeah. I'm very aware that we are now at 4:30, so I'm afraid we're going to have to leave the questions there. Just a couple of other things to mention to you. Next slide, please. We've got a couple of further webinars which might be of interest to you. One on the 29th of April at 4 p.m, building towards net zero, what is it and how do we get there? And we're joined at that by external speaker, Professor Sean Smith of the University of Edinburgh. And then a further webinar on the 19th of May, again at 4 p.m, payment and insolvency in the construction industry. Again, there are, you can sign up for those on our website. And finally, if you need any further information, please fill in the feedback form to enable us to hone our webinars to suit you, but also have a look at our LinkedIn group, our construction LinkedIn page. where we update regularly on bits of information relevant to the construction industry, and where you'll also find these slides and recording in due course. And also our construction and engineering blog, which has numerous blogs over the last 2 to 3 years on various different aspects of construction. Otherwise, all it remains for me to say is thank you for attending this webinar. I hope you enjoyed it. Many thanks.